Disclaimer.
Stop scrolling and listen carefully. While you were celebrating Christmas, silver exploded to 78.85 per ounce, the highest price in human history, capping a 169% surge that caught almost everyone off guard. But here's what should grab your attention. Russia and China have been coordinating strategic moves in the shadows for months, and when Monday morning hits, the silver market might face chaos, unlike anything we've seen in modern commodity trading. Here's what should grab our attention. While we were focused on stocks, real estate, and crypto, two nations quietly positioned themselves to control the most critical industrial metal of the modern economy. Not gold, which mostly sits in vaults looking pretty. Silver, the metal that makes your phone work, your solar panels generate power, and your electric vehicles run. The metal that conducts electricity better than any other element on Earth, cannot be substituted in most applications, and is being consumed faster than it's being mined for the third consecutive year. Pop quiz. Which country controls 60 to 70% of the world's refined silver supply? If you guessed China, you're starting to see the pattern. Now here's the part that changes everything. On a quiet day that received almost zero Western media coverage, Chinese officials announced something that will fundamentally alter silver markets starting January 1st, 2026. Mandatory export licenses for all silver leaving the country. Think about what that actually means for a moment. The nation that refines more than half the world's silver just claimed the power to decide who gets it and who does not. You might be wondering why this matters to you personally. Let me paint you a picture of what's happening in the physical silver market right now, because the price you see on financial websites doesn't tell the complete story. In Shanghai, silver prices approached $80 per ounce before the export restrictions were even announced, and dealers are reporting something they've never seen before, premiums of $15 to $20 above the spot price just to secure physical metal. That's not a typo. People are paying nearly $100 per ounce for actual silver you can hold in your hand, while paper contracts trade at $78. What does that tell you about the relationship between what's claimed to exist and what actually exists? Now let's talk about Russia, because this is where the coordination becomes impossible to ignore. According to official Russian customs data, precious metals exports to China doubled in the first half of 2025 compared to the previous year. We're talking about $1 billion versus $550 million. But here's where it gets really interesting. The Russian government allocated 51 billion rubles. That's roughly $500 million US, specifically for strategic silver and precious metals purchases running through 2027. Not gold, not oil. They're specifically targeting silver, and they're doing it on a timeline that perfectly mirrors China's export restrictions. Have you noticed how Russia and China have been settling their trade lately? According to the latest data from both central banks, nearly 100% of bilateral trade between these two nations now happens outside the dollar system. 100%. They've built an entirely parallel financial infrastructure, and on December 8th, 2025, they unveiled the next phase. BRICS nations launched a prototype currency called the unit, backed 40% by gold and 60% by BRICS member currencies. Not a proposal, not a concept paper, an actual working prototype that members are already testing for cross-border settlements. Let me connect these dots for you in a way that makes the Monday market threat crystal clear. China controls the supply. Russia is buying aggressively and has the budget allocated for years. Both nations have abandoned the dollar for their mutual trade. They've launched a gold-backed currency system that directly competes with Western financial infrastructure. And now, starting January 1st, China gets to decide who receives silver and who gets cut off. Think about the leverage that creates. Think about what that means for American industries that depend on silver for critical manufacturing. The solar industry alone provides a perfect example of how tight this market has become. According to the Silver Institute's latest industrial demand report, solar panel manufacturing will require 783 million ounces of silver over the next 3 years. That's not total silver demand, that's just solar. Add in electronics, medical devices, electric vehicle components, 5G infrastructure, and hundreds of other applications. And industrial demand hit a record 680.5 million ounces in 2024. Now here's the mathematical problem that can't be negotiated away. Global mine production runs around 840 million ounces annually, and that number has stayed essentially flat for 5 years, despite prices rising dramatically. You don't need a PhD in economics to see where this is heading. We're consuming silver faster than we're digging it out of the ground, and the two nations that control refining capacity just positioned themselves to restrict supply to Western markets right as industrial demand accelerates. This isn't theory, it's already showing up in warehouse data. JP Morgan's COMEX registered silver inventory, which represents metal available for immediate delivery, dropped 50% recently. They're down to 16.8 million ounces. For context, that's barely 2 weeks of global industrial demand sitting in the largest silver warehouse in North America. Meanwhile, China's own exchange inventories hit decade lows right after the record export surge in October 2025, just before the restriction announcement. They flooded the market, collected Western currency, and then slammed the door shut. It's the same playbook they ran with rare earth elements back in 2010, except the stakes are exponentially higher. Because silver is embedded in infrastructure we can't function without. You can design around rare earths if you're desperate. You cannot design around silver's unique electrical properties in most modern applications. What makes this particularly urgent for American investors is the timing mechanism built into China's export license system. Starting January 1st, any company wanting to buy Chinese silver has to apply for permission. That application process gives Chinese officials complete visibility into who's buying, how much they're buying, and what they're using it for. It transforms silver from a commodity into a geopolitical lever that can be pulled whenever strategic interests align. And based on Russia's documented buying pattern and budget allocation, those interests are aligning right now. The Hunt brothers' silver corner in 1980 provides an instructive parallel, though the current situation is actually more severe in several key ways. When the Hunt brothers tried to corner the silver market, they pushed prices to $50 per ounce before regulators intervened and changed the rules mid-game. That $50 in 1980 equals approximately $185 today when adjusted for inflation. But here's the critical difference. The Hunt brothers were private speculators vulnerable to regulatory action. China and Russia are sovereign nations with strategic objectives that extend far beyond profit. They can't be margin called. They can't be regulated. And they're playing a much longer game than the Hunts ever envisioned. Think about what happens when markets open Monday morning and institutional buyers start processing these implications. Not the ones who've been tracking this development for months. They've already positioned themselves, which explains why silver mining stocks like Hochschild Mining are up 128% this year. I'm talking about the fund managers, the industrial purchasing departments, the manufacturers who have been assuming silver would always be available at reasonable prices. What happens when they realize the world's primary supplier just activated an export control regime with no clear end date? According to recent lease rate data, we're already seeing the early tremors of institutional panic. Silver lease rates spiked to 8 to 9% annually in late December. Under normal market conditions, silver lease rates run between 0.5% and 1% because silver is supposed to be abundant and liquid. When you see lease rates approaching 9%, that's financial institutions desperately trying to secure physical metal and willing to pay nearly 10 times the normal cost to borrow it. That's not market noise. That's a scramble for supply that's already underway before most investors even know there's a problem. The mathematical reality facing us is straightforward and unavoidable. The silver market has run a deficit exceeding 215 million ounces annually for 3 consecutive years. That deficit exists even with Chinese exports flowing freely to Western markets. Now, subtract 500 to 700 million ounces that China could withhold through their export licensing system. Add Russia's strategic buying with their 51 billion ruble allocation. Factor in record industrial demand that cannot decrease without shutting down critical manufacturing. You're looking at a supply shock that has no modern precedent in commodity markets. This is why Monday matters specifically. Markets have been closed for the holiday period. Decision makers have been away from their desks. The export license system activates January 1st. Industrial buyers return from the holiday break during the first week of January, and that's when procurement departments across American industries will start submitting their quarterly orders and discovering that the supply chain they've relied on for decades just fundamentally changed. Price discovery in a market that tight, with that much institutional buying pressure hitting simultaneously, creates the kind of volatility that either makes fortunes or destroys them depending on which side of the trade you're positioned. The window for understanding this situation before it becomes mainstream news is measured in days, not weeks. Once the financial media catches up to what is happening, and my estimate is mid-January based on how long similar stories took to gain traction, the opportunity to position ahead of the crowd closes. We're currently in that brief period where the mechanism is in place, the data is public, and the implications are clear to anyone paying attention, but the broader market hasn't priced in the reality yet. That disconnect never lasts long in modern markets. What we're witnessing isn't just a commodity squeeze. It's the weaponization of supply chains by nations that have spent years building alternatives to Western financial infrastructure. The silver export restrictions are one piece of a larger strategy that includes the unit currency, de-dollarization of trade, and the accumulation of strategic resources that Western economies depend on. Understanding silver's role in that broader strategy is essential to grasping why this specific development carries implications far beyond metal prices. Let me show you exactly what's happening on the ground right now. Because the disconnect between paper prices and physical reality has reached levels that veteran traders are calling unprecedented. When Shanghai silver prices approached $80 per ounce in late December, that wasn't speculation or futures trading driving the number. That was actual buyers in China paying premiums that should be impossible in a functioning market. You want to know what real supply shortage looks like? It looks like industrial buyers offering $20 premiums over spot price just to secure delivery and still facing weeks of delay. Here's what that premium structure tells us about the actual state of physical silver availability. Under normal market conditions, you might see premiums of 50 cents to $2 per ounce for retail coins and bars. Industrial buyers purchasing in bulk usually pay spot price or even slight discounts because they're moving large quantities. When those same industrial buyers are offering $15 to $20 premiums, you're witnessing the market screaming that available supply has already evaporated. This is not future concern. This is present reality that most Americans don't see because they're looking at COMEX futures prices instead of actual transaction data from physical dealers. The COMEX warehouse situation provides hard evidence that validates everything I've been explaining. JP Morgan's registered inventory, and this is crucial to understand the difference. Registered means metal that is available for immediate delivery against futures contracts. Not eligible, which is metal sitting in the warehouse but already owned by someone. Registered inventory at JP Morgan dropped from over 30 million ounces to 16.8 million ounces. That's a 50% decline in available deliverable silver at the single largest silver warehouse in North America. Think about the implications. The institution that has been the dominant player in silver markets for decades just saw half of its deliverable inventory disappear. Now let's look at what's happening on China's exchanges, because this is where you see the coordination become undeniable. Shanghai Futures Exchange, silver inventories hit to their lowest levels in a decade, right after that massive October 2025 export surge. According to data from the exchange itself, Chinese warehouses pushed out record volumes of silver in September and October, flooding Western markets and keeping prices temporarily suppressed. Then came the export license announcement in November, and suddenly those inventories that had been flowing west stopped completely. They executed a textbook supply drain, extract maximum value at relatively low prices, then cut off the spigot once your own inventories are positioned exactly where you want them. You might be thinking, this is just normal market dynamics, supply and demand finding equilibrium. Let me show you why the mathematics make that interpretation impossible. The Silver Institute, which tracks global supply and demand data that's considered the industry standard, reported that 2024 saw a deficit of 215.3 million ounces. That's the third consecutive year the deficit exceeded 200 million ounces. We're not talking about a temporary imbalance that mine production can solve by increasing output. Global mine production has been stuck at approximately 840 million ounces annually for 5 years running, despite silver prices more than doubling during that period. Think about what that means from a basic economics perspective. Price signals are supposed to incentivize increased production. Silver prices have surged from $15 to nearly $80 per ounce, and mine output hasn't budged. Why? Because silver isn't usually mined as a primary product. According to the World Silver Survey, roughly 70% of silver production comes as a byproduct of mining other metals: copper, lead, zinc, and gold. You can't just open more silver mines in response to higher prices because the economics don't work that way. You're dependent on base metal mining operations that make decisions based on copper or zinc prices, not silver. Meanwhile, industrial demand hit 680.5 million ounces in 2024, and that's before the massive solar expansion that's coming. The Solar Energy Industries Association's projections show that photovoltaic panel manufacturing will consume 783 million ounces over the next 3 years. That's 250 million ounces per year just for solar. And those numbers are based on current installation targets that have only been increasing as nations accelerate renewable energy transitions. Every single solar panel requires silver paste for the electrical contacts. There's no substitute material that matches silver's efficiency and durability at the temperatures solar panels operate under. Let me give you a concrete example of why substitution isn't solving this problem. Engineers have been trying to reduce silver content in solar panels for over a decade. They've succeeded in cutting the amount per panel from roughly 20 grams in 2010 to about 12 grams today. Sounds like progress, right? Except solar installations have grown so dramatically that total silver consumption by the industry has actually increased despite using less per panel. According to the International Energy Agency, global solar capacity additions are on track to exceed 400 gigawatts annually by 2026. Each gigawatt requires approximately 1 million ounces of silver when you calculate panel production volumes. Do that math. 400 million ounces per year just for new solar installations. Now add electric vehicles to the equation, because each EV contains approximately 1 ounce of silver in various electrical components, contacts, and systems. Global EV sales hit 14 million units in 2024, according to industry data, and most projections show that number reaching 30 million units by 2030. Then you have 5G infrastructure, where each small cell tower uses roughly 3 times as much silver as 4G equipment due to the increased number of connections and higher frequency requirements. Medical devices, water purification systems, industrial catalysts, photography, mirrors, batteries. The list of applications consuming silver industrially goes on and includes hundreds of products that modern economies cannot function without. Here's where Russia's pattern becomes impossible to dismiss as coincidence. Their documented silver and precious metals buying surge in 2025 mirrors exactly what China did between 2010 and 2022, except we only discovered China's accumulation years after it happened because they weren't required to report it transparently. Russia's customs data shows that billion-dollar jump in precious metals exports to China in just 6 months. But that's outbound. What about inbound? Russian miners are among the world's top 10 silver producers, generating roughly 45 million ounces annually. When you see Russia allocating 51 billion rubles for strategic metals purchases through 2027 and simultaneously exporting record amounts to China, you're watching a coordinated accumulation strategy. The refining capacity control is what makes this truly dangerous for Western supply chains. China and Russia together control approximately 48% of global silver refining capacity, according to data compiled by Metals Focus, a leading precious metals research firm. That's not mining. That's refining, which means taking raw silver from mines and processing it into the pure forms that industry actually uses. You can mine silver anywhere, but you need sophisticated refining operations to produce the quality required for industrial applications. When half the world's refining capacity is controlled by 2 nations actively coordinating their strategic resources policies, that's a choke point that can be weaponized. We've seen exactly this playbook before with Chinese rare earth elements. In 2010, China controlled about 95% of global rare earth production and refining. When they imposed export restrictions during a territorial dispute with Japan, rare earth prices spiked between 500 and 1,000% in less than a year. Neodymium, which is critical for electric motors and wind turbines, went from $35 per kilogram to near $500. Dysprosium jumped from $150 per kilogram to over $3,000. Industries worldwide faced shortages that threatened to shut down production lines. That crisis forced Western nations to recognize the strategic vulnerability of depending on a single supplier for critical materials. The difference is that silver's industrial applications are far more widespread and critical than rare earths. You can potentially redesign some products to use less rare earths or find alternative materials, though it's expensive and time-consuming. With silver, the unique combination of electrical conductivity, thermal conductivity, reflectivity, and malleability makes it essentially irreplaceable in most applications. There is no drop-in substitute for silver in solar panels that maintains efficiency. There is no alternative for high-frequency electrical contacts in 5G equipment. Medical applications require silver's antimicrobial properties that no other element can match at similar cost and safety profiles. Let me put the supply shock math in terms that make the Monday market threat concrete. Start with the baseline deficit of 215 million ounces that already exists with normal Chinese exports. Now, China implements export licenses that could reduce Western market access by 500 to 700 million ounces. That's their rough annual export volume to non-BRICS nations based on historical trade data. Add Russia's strategic buying, which based on their budget allocation, could absorb another 50 to 100 million ounces annually. You're looking at a combined supply reduction hitting Western markets that ranges from 750 million to over 1 billion ounces. Compare that to total annual mine production of 840 million ounces globally. Think about those numbers for a moment. The potential supply removal exceeds total annual mining output. Even if mine production increased, which it won't significantly in the near term, you're facing a supply shock that cannot be solved by normal market mechanisms. This is why lease rates spiked to 8 to 9%. Financial institutions that specialize in precious metals lending understand the mathematical reality, and they're charging crisis-level rates to lend silver because they know the probability of not getting that metal back at reasonable prices is extremely high. The warehouse data confirms that sophisticated players have been positioning ahead of this for months. When you see 50% inventory drops at major COMEX warehouses while prices are rising, that tells you someone is taking delivery of physical metal and removing it from the available supply. This isn't typical behavior. Usually in rising price environments, more metal comes out of storage and gets sold into the market. When metal keeps disappearing from warehouses despite rising prices, you're seeing accumulation by entities that understand something the broader market doesn't yet grasp. China's October export surge now makes perfect strategic sense in hindsight. They flooded the market with silver at prices between $60 and $70 per ounce, collected hundreds of millions in Western currency, and simultaneously prevented Western prices from spiking before their export restrictions activated. That kind of market timing doesn't happen by accident. It is evidence of coordinated policy execution that was planned months or quarters in advance. The export license announcement came in November, but the preparations were clearly underway throughout the second half of 2025. What should terrify industrial buyers in particular is that China's export license system gives them perfect intelligence on Western demand. Every application must specify the quantity needed and the intended use. That means Chinese officials will know exactly which industries are desperate for silver, how much they need, and what they're willing to pay. In negotiation terms, that's called perfect information asymmetry. One side knows everything, the other side knows nothing about Chinese supply availability or allocation priorities. That imbalance allows China to maximize strategic advantage while minimizing their own vulnerabilities. The BRICS unit currency prototype adds another layer to this strategy that most analysis has missed. By backing their new currency 40% with gold and 60% with member nation currencies, BRICS creates immediate demand for gold that supports prices and establishes credibility. But silver represents the next logical step. It's a monetary metal with massive industrial demand. China controls the supply, and adding it to the unit backing would create instant appreciation, while further differentiating from dollar-based systems. Russia's strategic metals allocation specifically mentions silver alongside precious metals, suggesting they're positioning for exactly this eventuality. Here's what keeps me up at night about the timeline. All the pieces are in position. Export restrictions, strategic buying, currency alternatives, refining control, and existing supply deficits. The catalyst is literally just markets opening and participants recognizing what's already happened. Once that recognition spreads beyond the specialized traders who've positioned early, you get a price discovery event where the market has to find a level that balances actual available supply against genuine demand. Based on the rare earth precedent and the Hunt brothers spike adjusted for current supply tightness, that level is substantially higher than current prices, potentially $100 to $120 or more once the full supply shock becomes apparent. Let me walk you through the mathematics that make this outcome not just probable, but virtually inevitable barring some dramatic policy reversal. Start with the baseline we've already established. A 215 million ounce annual deficit that exists right now, with Chinese silver flowing freely to Western markets. That deficit has persisted for 3 consecutive years despite rising prices, which tells you it's structural, not cyclical. Industrial demand is not going to decrease because manufacturers can't simply turn off production lines or stop installing solar panels without abandoning their entire business strategies. Now layer in the China export restriction impact. Chinese refined silver exports to Western markets have historically run between 500 and 700 million ounces annually based on international trade data compiled by the World Bureau of Metal Statistics. When those export licenses activate January 1st, China gains discretionary control over that entire volume. They don't have to cut off all exports immediately to create chaos. Even a 30 to 40% reduction would remove 200 to 300 million ounces from available Western supply. But given the coordination we're seeing with Russia and the BRICS currency initiatives, there's every reason to expect much more aggressive restrictions as their strategic objectives become clearer. Add Russia's documented buying program with that 51 billion ruble allocation running through 2027. At current exchange rates and silver prices, that budget could absorb approximately 50 to 100 million ounces annually, depending on how aggressively they execute purchases. Russian entities are already sophisticated players in precious metals markets, and they have the advantage of buying through multiple channels that make it difficult for Western analysts to track the full extent of their accumulation. When you combine state buying with private Russian investors responding to the same signals, you could easily see another 100 million ounces of annual demand coming from Russia alone. Here's where the math becomes undeniable. Take the existing 215 million ounce deficit, add a conservative 500 million ounce reduction in Chinese exports to Western markets, and include the 100 million ounces of Russian strategic buying. You're looking at a minimum 815 million ounce supply shock, and that's using the most conservative assumptions. If China restricts exports more aggressively, say by 60% instead of 70%, or if additional BRICS nations join the strategic accumulation program, you could be looking at over 1 billion ounces of supply removed from Western markets by the second quarter of 2026. Compare that to the Hunt brothers situation in 1979 and 1980, because the parallel is instructive even though current fundamentals are actually tighter. The Hunt brothers accumulated roughly 200 million ounces of silver through futures contracts and physical purchases. That accumulation, combined with inflation concerns and Middle East tensions, drove prices from $6 per ounce in January 1979 to $50 by January 1980. That's a peak that, adjusted for inflation using Bureau of Labor Statistics data, equals approximately $185 in today's currency. They achieved that price spike by cornering roughly 20% of annual supply in a market that had much larger above-ground inventories than exist today. Think about the scale difference. The Hunt brothers. Cornering 20% of supply drove prices to inflation-adjusted levels of $185. We are potentially seeing 50 to 80% of Western supply access restricted through sovereign nation policies that can't be margin called or regulated into submission like private speculators. The mathematical precedent suggests that if 20% restriction drives prices to those levels, a 50 to 80% restriction should drive prices substantially higher, potentially $100 to $150 per ounce or more once markets fully adjust to the new supply reality. The 2011 silver spike provides another data point for price discovery in tight physical markets. Silver briefly touched $49 per ounce in April 2011 during the sovereign debt crisis, when investors were fleeing to hard assets. That spike happened with no supply restrictions in place. It was purely demand-driven by investors seeking alternatives to fiat currencies. The price roughly doubled in 6 months, from $25 to $49, on investment demand alone. Now imagine that kind of investment demand hitting simultaneously with actual supply restrictions that affect industrial buyers, who have no choice but to secure silver regardless of price. You want to understand the timeline mechanics? Here's how this likely unfolds day by day. January 1st, China's export license system activates. The first week of January, industrial procurement departments return from holiday breaks and begin submitting quarterly orders. Those orders hit Chinese suppliers who now have to apply for export licenses, creating immediate delivery delays, even for approved transactions. By mid-January, word starts spreading through industrial supply chains that lead times have extended from weeks to months, or that certain orders are being denied entirely without explanation. That's when you will see the first wave of panic buying from industrial users who suddenly realize they might not be able to source silver through normal channels. According to the typical supply chain timelines in electronics and solar manufacturing, companies generally maintain 30 to 90 days of silver inventory. If they can't secure delivery commitments for the next quarter, they're facing potential production shutdowns within months. That is not a situation where they negotiate on price. They pay whatever it takes because the alternative is closing factories and breaking customer commitments worth billions. The BRICS summit, expected in February or March 2026, adds another catalytic event to this timeline. If that summit announces expansion of the unit currency to include silver backing, or if they announce expanded membership with additional nations joining the BRICS bloc, you get a second wave of both strategic buying and investment demand. Markets will be forced to price in not just current supply restrictions, but the likelihood of permanent structural changes to how silver is allocated globally. That's when prices could move from the $100 range into territory that sounds absurd right now but becomes inevitable once you accept the supply shock mathematics. The lease rate spike we are already seeing to 8 to 9% provides real-time confirmation that institutional players are scrambling. Under normal conditions, silver lease rates run between 0.5% and 1% annually because silver is supposed to be abundant and easily borrowed. When lease rates jump to 9%, that's institutions paying enormous premiums to borrow metal, which means they're either covering short positions or securing supply for clients who are desperate. According to data from the London Bullion Market Association, lease rates at these levels haven't been sustained since the 2008 financial crisis, and even then, they only spiked briefly before returning to normal levels. What is different now is that the high lease rates are not driven by temporary liquidity crisis. They are driven by genuine supply shortage that's going to worsen, not improve. When lease rates stay elevated for months instead of days or weeks, that's the market pricing in a structural problem that normal supply chain adjustments can't solve. Borrowers are willing to pay 9% annually to secure silver because they believe the alternative is either not having any silver available at any price or having to pay spot prices that are significantly higher than current levels plus 9% interest. Let me address what you're probably wondering. Can this really happen in modern markets with all their circuit breakers and regulations? The short answer is yes, because sovereign nations are involved and the regulations that stop the Hunt brothers don't apply. In 1980, the COMEX changed its rules mid-crisis to allow only liquidation orders, preventing new long positions in silver futures. That regulatory intervention, combined with margin requirement increases and coordinated central bank action, broke the Hunt brothers' corner and sent prices crashing back down. Those tools don't work against China and Russia. You can't margin call a sovereign nation. You can't change exchange rules to prevent Chinese entities from buying silver. They're buying physical metal in their own territory with their own currency. The regulatory framework that exists to prevent market manipulation applies to traders operating within Western financial systems. It has no authority over sovereign nations executing strategic resource policies on their own soil. This is the critical difference that makes the current situation more dangerous than any previous silver squeeze. The entities controlling supply are beyond the reach of Western financial regulation. Now, let's talk about positioning, because this is where individual investors still have a brief window to act on information that is not yet reflected in mainstream coverage. Silver mining stocks like Hochschild Mining have surged 128% this year, which tells you that sophisticated investors who follow supply chain data closely have been positioning for months. But according to recent surveys from precious metals dealers and financial advisors, roughly 80% of retail investors remain completely unaware that China implemented export restrictions. That awareness gap creates opportunity for those who understand the situation before the gap closes. The window for getting positioned ahead of mainstream coverage is closing rapidly, and my estimate is that you have until mid-January before the financial media starts running comprehensive stories about Chinese silver restrictions and their implications. Once CNBC, Bloomberg, and the Wall Street Journal start covering this extensively, you're no longer early. You're reacting to news that millions of other investors are seeing simultaneously. At that point, price discovery happens so quickly that attempting to position feels like chasing a runaway train. Think about your own situation for a moment. If you're invested in stocks, bonds, or real estate, how does a rapid silver price spike to $100 or $120 per ounce affect those holdings? Rising industrial input costs squeeze corporate profit margins. Inflation concerns could force our Federal Reserve to maintain higher interest rates longer than markets currently expect. Supply chain disruptions in electronics and solar industries create ripple effects through entire sectors. This is not just about whether you own silver directly, it's about understanding how a critical commodity shock affects the broader financial environment where all your investments exist. For Americans specifically, there's a national security dimension here that goes beyond investment returns. Our military hardware, our renewable energy infrastructure, our electronics manufacturing, our medical device production, all of it depends on reliable silver supply at reasonable prices. When potential adversaries control access to a strategic material this critical, that's a vulnerability that affects our economic security regardless of whether you personally invest in precious metals. Understanding these supply chain realities helps you make better decisions about everything from career choices to where you invest retirement savings to how you think about long-term economic trends. The empowering aspect of this knowledge is that awareness creates options. If you understand that industrial silver demand is structural and increasing, that supply is genuinely constrained, and that major nations are positioning to control that supply for strategic advantage, you can make informed decisions, instead of being blindsided when prices spike. You can position a portion of your portfolio to benefit from these trends. You can adjust your business strategy if you operate in affected industries. You can have conversations with financial advisors about hedging exposure to commodity price shocks. What I want you to take away from this isn't fear or panic, it's understanding. The silver market is being reshaped by sovereign nation strategies that have been building for years and are now reaching execution phase. The mathematics of supply and demand are straightforward once you have the data. The timeline is compressed because all the pieces activated simultaneously right as we entered 2026. The price implications follow logically from historical precedents, adjusted for current market conditions that are actually tighter than those precedents. This is why Monday matters. Markets reopen, participants return from holidays, and the first wave of industrial buyers starts encountering the new reality of Chinese export licenses. Price discovery in markets this tight happens fast, especially when it's driven by must-have industrial demand rather than optional investment speculation. The Hunt brothers reached $50 with 20% of supply. China controls 60 to 70%. Russia is buying strategically. The existing deficit already exceeds 200 million ounces annually. The math isn't complicated. It's just unpleasant for anyone who needs silver and isn't already positioned. For those wondering whether this could all reverse if China suddenly lifts restrictions, consider what strategic objective they would abandon to do so. They're building parallel financial infrastructure with BRICS. They're de-dollarizing trade relationships. They're establishing themselves as the critical link in supply chains for strategic materials. Lifting silver export restrictions would undermine all those objectives while gaining them nothing except temporary goodwill from Western nations they're actively trying to reduce dependence on. From a pure strategic calculation standpoint, maintaining and potentially tightening these restrictions serves their long-term interests far better than any short-term economic benefit from increased exports. The opportunity and the threat exist simultaneously in the same market dynamics. Those who understand the supply shock mathematics and position accordingly stand to benefit significantly as prices adjust. Industries and investors who remain unaware face sudden cost increases and supply insecurity that could impair operations and portfolio values. Knowledge creates the difference between those two outcomes, which is why I'm sharing this analysis now, while there's still time to act on it before the information becomes common knowledge. We're living through the early stages of a commodity market restructuring that will be studied in economics textbooks for decades. The question isn't whether silver prices rise substantially from current levels. The supply and demand mathematics make that outcome nearly inevitable. The question is whether you understand what's happening in time to position yourself and your investments appropriately, or whether you discover these dynamics after prices have already adjusted and the opportunity to benefit has passed. Monday morning is when the real price discovery begins. Now you know why.